All right, let's talk about banking. It's something we all use, right? But how many of us really, truly know what's going on behind the scenes? What actually happens to our money after we deposit it? Well, from your own savings account all the way up to the entire global economy, the banking system is this massive, incredibly complex machine. So today, we're going to pop the hood and see exactly how it works. And just to give you a sense of the scale we're dealing with, look at this number. That's $25 trillion. That is the amount of assets held by just the top 10 banks in the world. It's a number so huge it's almost impossible to wrap your head around. And it's the engine that powers, well, everything. Yeah, you heard that right. A bench. This multi-trillion-dollar global system, with all of its computers and complexity and power, it all started with something unbelievably simple. And to really get how we got here, we've got to go all the way back to the beginning. So let's do it. Let's take that journey and see how we went from a simple bench to a global powerhouse. Okay, picture this. It's the 11th century in Italy, which is basically the center of European trade. If you're a merchant, your life is kind of chaotic. You're dealing with dozens of different coins, you've got to watch out for counterfeits, and oh yeah, there's the constant threat of being robbed. So to fix this, some clever money exchangers set up shop on outdoor benches, or banco in Italian. And hey, that's where we get the word bank. Then came the real game changer. Goldsmiths, who were storing people's gold for them, had a light bulb moment. They realized, hey, all this gold is just sitting here. What if we lent it out and charged interest? That simple idea was the spark. And pretty soon, networks of real banks spread across Europe, becoming the essential middlemen for all of commerce. So that's the absolute key takeaway. At its core, a bank was never just a vault to store money. It was a matchmaker. It's a trusted go-between that connects people who have extra money with people who need money. It's all about managing risk and making the whole economy run a lot more smoothly. So, now let's flash forward and see how that simple idea evolved into the monster system we have today. How did that basic middleman turn into a profit-generating machine that can, and I mean this literally, create money out of thin air? The wild thing is, the basic business model is still incredibly simple. Look, you, the saver, you deposit your money. In return, the bank pays you a little bit of interest. Then the bank turns around and lends that money to a borrower, but at a much higher interest rate. That difference between the two rates, that's called the spread, and that's the bank's profit. It's how they make money. They're essentially turning your savings, which were just sitting there, into active funds someone can use to buy a house or start a business. And okay, this is the part that really blows people's minds. I think we all have this image in our heads, right? We deposit $100 and we picture that $100 sitting in a big, secure vault with our name on it, just waiting for us. But that could not be further from the truth. Here's what actually happens. Let's say you deposit $1,000. The bank is only legally required to keep a tiny piece of that, a fraction, say 10%, so $100, in its vault. It then takes the other $900 and loans it out to somebody else. Now stop and think about this for a second. Your account still says you have $1,000, but now another person has $900 of cash in their hand. Your original $1,000 has magically become $1,900 circulating in the economy. The bank has effectively created new money. This whole system has a name. It's called Fractional Reserve Banking, and it is the engine of the modern economy. It allows money to multiply, which in turn fuels growth and investment. And, it works perfectly until it doesn't. And that, of course, brings us to what happens when the managing risk part of the equation goes completely horribly wrong. See, in the years before the 2008 crisis, a lot of the big banks kind of forgot what they were supposed to be doing. They drifted away from that stable, long-term lending model and got into super high-risk, short-term trading. Why? They were chasing insane profits and even crazier bonuses. It became less about careful lending and more about just making a fast buck. And this all came to a head with what we now call the subprime mortgage crisis. This is when banks started just handing out incredibly risky home loans to people with bad credit. I mean, they were basically lending to almost anyone who walked in the door, whether they could pay it back or not. And that put the entire system on a knife's edge. So what happens when you give loans to millions of people who can't actually afford them? Well, surprise, surprise, they start to default. And when they did, the entire U.S. housing market collapsed. Home values just plummeted, and all those fancy financial products that were built on top of these bad mortgages, they became worthless almost overnight. Now, this wasn't just an American problem. It was a contagion. It triggered a global banking crisis. Stock markets crashed, credit completely froze up, and governments all over the world had no choice but to step in with massive bailouts, using taxpayer money to stop the whole system from imploding. And the real-world consequences were just devastating. Hundreds of billions of dollars just vanished. Millions of ordinary people lost their jobs, their homes, their life savings. Now, in the aftermath, there were some big changes.
New regulations were created to try and prevent a repeat. And importantly for all of us, government deposit insurance, like the FDIC here in the US, was reinforced. That's what guarantees that your money, up to $250,000, is safe in a bank no matter what happens.
The 2008 crisis was a massive, painful wake-up call. But it also sparked a wave of innovation, with people asking, hey, is there a better way to do this? And a ton of new models started to pop up, challenging the old way of doing things. Let's just compare a few of them. So you've got your traditional bank, right? Their main goal is to maximize profit for their shareholders. But then you have something like a credit union. That's a cooperative. It's owned by its members. So its goal isn't profit, it's creating shared value for everyone who's a member. And then you have crowdfunding, which just cuts out the bank entirely and lets people like you and me directly fund the businesses and ideas we believe in. And the innovation doesn't stop there. You have some new investment banks that charge a flat fee instead of a commission, which gets rid of the shady incentive to sell you stuff you don't need. And you have things like microcredit, which gives really small loans, mostly in developing countries, to entrepreneurs who were totally ignored by the old system, helping them start businesses and pull themselves out of poverty. So when you boil it all down, banking might seem really complicated, but its core job is actually simple and it's vital. It's about providing the funds that let our world build and grow and innovate. The 2008 crisis showed us just how dangerous it is when that system breaks. But all these new models emerging today prove that the future isn't set in stone. The fundamental question is still there. Who do we trust to be that middleman, and what values should guide them? And that's something for all of us to think about.